Welcome to the Deep Dive. Today we're taking a step-by-step look into decentralized finance. You've probably heard it called DeFi.
We have. It's a really fast-moving area, full of potential, but honestly, sometimes it feels like you need a translator just to get started.
That's exactly why we're here. We're diving into our sources today, trying to pull out the key stuff and, make it click for you.
Yeah, we'll cover the history, how it actually functions, the big question of who's in control, the risks, and there are definitely risks, and maybe a glimpse into where it's all heading.
Right. We've waded through a lot of material, from the basics to the bleeding edge. The goal is really those aha moments, making sense of it without drowning you in jargon. So let's start at the beginning. Where did DeFi come from?
Well, you really have to start with blockchain. Our sources point back to 2008, Satoshi Nakamoto, and the Bitcoin white paper.
The famous white paper.
Exactly. The core idea was enabling electronic transactions directly between people, cutting out the middleman, like a bank, and hopefully lowering fees, too.
Why was that needed? What was wrong with traditional banking?
Well, the sources highlight a couple of key issues, things like having a single point of failure. If the bank system goes down, you're stuck. And also the whole issue of trust. You have to trust the institution.
Okay, so blockchain was the proposed solution, but what is it, fundamentally?
Think of it like a shared digital notebook.
Yeah.
But instead of being in one place, it's copied across potentially thousands of computers. It's distributed.
Distributed, okay.
And crucially, it has integrity. The records are trustworthy and immutability. Once something's written down, it's incredibly hard to change it. Almost impossible, practically speaking.
How does it achieve that? Sounds a bit like magic.
It uses cryptography. Digital signatures and complex math hash functions verify every transaction. And because there's no central boss, everyone needs to agree on the state of the ledger through consensus protocols.
Consensus, right.
One source actually describes it nicely. Blocks of data linked chronologically and cryptographically. Tampering becomes an astronomically tricky task. Each block knows the one before it, forming that chain.
A chain of trust built on code. And Bitcoin was the first big example of this.
Precisely. Bitcoin really showed the world what this distributed ledger technology could do. But DeFi specifically builds on that foundation for financial services.
So it evolved from Bitcoin.
Yeah, you can say that. A key moment mentioned in our sources was Maker Protocol launching on Ethereum back in 2017. That enabled stablecoins.
Stablecoins, we'll definitely need to get back to those.
We will. Then 2018 saw more platforms pop up, like Compound Finance, Uniswap. The whole DeFi ecosystem started expanding, partly fueled by that initial coin offering boom, the ICO craze.
Right, I remember that. And the money involved now is pretty significant.
Oh, absolutely. Sources note that total value locked TVL, you'll hear it called in DeFi, actually shot past $100 billion by late 2021. Even just Uniswap's governance tokens were worth over $16 billion at one point.
Wow. Has it stayed that high?
It fluctuates. Another source mentions around $39.77 billion locked in December 2022. Still a huge number, spread across thousands of DeFi services. Shows a lot of capital still involved.
Okay, so clearly significant value. Let's pin down that definition again. DeFi is.
The common phrase is, trust minimized finance on the blockchain without intermediaries. Basically, rebuilding financial services, lending, borrowing, trading, but decentralized.
And what are the most common uses right now?
According to our sources, the big ones are decentralized exchanges, DEXs. Then you have lending and borrowing platforms and various protocols for earning yield.
Okay, DXs, lending, yield. Got the basics.
Yeah.
Now, how does this actually work in practice? It's not like logging into my bank website, right?
Definitely not. Let's take DEXs as the main example. Unlike centralized exchanges where you deposit your money onto the exchange.
Right, like Coinbase or Binance.
Exactly. DEXs aim to let you trade crypto assets directly with others, using smart contracts to handle the swap. The key is the DEX itself ideally doesn't hold your funds.
So no central custodian. How do they match buyers and sellers then?
Well, our sources mention two main types of DEXs. First, order book exchanges. These might look a bit more familiar.
How so?
They have a list of buy and sell orders, the order book. People placing orders are makers. Those filling them are takers. The interesting part is the settlement, the actual asset swap, happens on the blockchain. But the order book itself might be managed off-chain by an operator. But even then, that operator might never actually control your crypto.
Okay, so the matching happens, maybe off-chain, but the deal itself is settled directly on the blockchain. What's the other type?
Automated market makers, or AMMs, these are quite different. They don't use traditional order books at all.
No order book. How do they set prices then?
They rely purely on smart contracts and pools of assets provided by users' liquidity providers. An algorithm within the smart contract determines the price based on the ratio of assets in the pool.
So math sets the price based on supply and demand within that pool.
Kind of, yeah. Think of it like a balancing scale. If lots of people buy token A from a pool of token A and token B, the price of token A goes up relative to token B within that pool.
Interesting. Okay, you mentioned stablecoins earlier. They seem crucial in this volatile crypto world. How do they fit in?
They're absolutely vital for DeFi. The whole idea is to bring some price stability. They try to peg their value to something less volatile, usually like the US dollar.
How do they maintain that peg?
Our sources break it down into four main types. First, fiat-backed. These are probably the most common ones you hear about.
Like USDT and USDC.
Exactly. They claim to hold reserves of actual fiat currency, like dollars, backing each coin issued. So 1 USDC is meant to be redeemable for $1 held in reserve.
Meant to be. Has that always held true?
There's been scrutiny, especially around Tether, USDT. USDC, issued by Circle, aims for more transparency with audits showing liquid assets backing it. But yeah, the idea is a digital dollar backed by real dollars.
Got it. What's next?
Then you have crypto-backed stablecoins. Instead of fiat, they use other cryptocurrencies as collateral.
But crypto prices swing wildly. How does that work?
Over-collateralization, that's the key. You have to lock up, say, $150 worth of Ethereum to borrow $100 worth of the stablecoin. That extra collateral acts as a buffer if the price of Ethereum drops. Smart contracts manage all this locking and liquidation. Examples are things like DAI, though it's evolved, and others like LUSD or GHO.
Okay, extra crypto as a safety cushion. Makes sense. Third type.
Algorithmic stablecoins. These are more ambitious. They try to hold their peg using algorithms and smart contracts to control supply and demand without direct collateral backing.
No collateral. Sounds risky.
It can be extremely risky. We saw that with the collapse of Terra USD. When confidence breaks, the whole system can unravel very quickly.
Yeah, that was a big one. And the last type.
Commodity-backed. So backed by physical assets like gold. Think Pass Gold, PXG, or Tether Gold. Each token represents ownership of a certain amount of gold held in a vault.
So its price moves with gold, not necessarily pegs to a dollar.
Exactly. Which leads to some debate, as our sources note, whether they're truly stable coins in the same sense as fiat-pegged ones, or more like tokenized commodities.
Right. So DeFi uses all these new tools, smart contracts, AMMs, different stable coins, but it often seems like it's trying to do things traditional finance already does, just differently.
That's a really important insight. It's often replicating functions like lending, borrowing, exchange, but with different plumbing, different infrastructure. And that comes with its own set of potential vulnerabilities, which are quite distinct from traditional finance.
Okay, we've got the mechanics down, but let's rewind a bit. Where did the actual concept come from? We mentioned Bitcoin.
Right. The 2008 Bitcoin white paper is the clear origin point cited in our sources. That core desire for peer-to-peer electronic cash, bypassing trusted third parties.
So avoiding banks and payment processors.
Essentially, yes. Addressing issues like central control, potential censorship, or even manipulation, Bitcoin planted that seed. Maybe we don't need the intermediary for financial transactions.
Was there anything before Bitcoin that sort of paved the way for thinking like this?
Well, if you look at the broader history of fintech, our sources point to things like online banking emerging in the mid-90s, Stanford Federal Credit Union, Wells Fargo.
Right, being able to check your balance online. Seems basic now.
It does. But back then, it was a big step towards remote access. Presidential Bank even let you open accounts online. While not decentralized, it was part of that shift away from purely physical banking. It conditioned people to interact with finance digitally.
So you can draw a line from, say, ATMs in the late 60s giving 247 access through online banking to now DeFi.
Exactly. DeFi is like a continuation, maybe even a radicalization of that trend, taking the removal of intermediaries much, much further.
Which brings us to that core question. Who actually controls DeFi? The name implies nobody, but is that really true?
That's the ideal, the core principle. No single boss like in a traditional bank. But the reality can be more nuanced.
How so?
Many DeFi protocols use governance tokens. The idea is to give the community, the users, a say in how the protocol evolves.
So token holders get to vote on changes.
Right. They can vote on proposals, maybe upgrades, fee changes, things like that.
Yeah.
But here's the catch our sources highlight. Often, the founding teams and early investors hold a lot of these tokens.
So their votes carry more weight.
Potentially, yes.
Yeah.
It means they can still have significant influence, even if the goal is decentralization. So community control is the aim, but power can still be quite concentrated.
So decentralization isn't always absolute in practice.
It's often a spectrum. And there are other risks, too. Someone could theoretically acquire a controlling stake of governance tokens, maybe even using a flash loan, a very short-term, uncollateralized loan.
Wait, uncollateralized loans?
In DeFi, yes, for the duration of a single transaction block. You borrow and repay huge amounts almost instantly. Someone could use one to borrow governance tokens, vote through a malicious proposal that benefits them, like draining funds, and then repay the loan all in one go.
That sounds like a major loophole.
It's a known attack vector, yes. It can harm minority token holders significantly, so the degree of decentralization varies, and it can change over time as governance evolves.
And that differs between types of projects, too, like those stablecoins we discussed.
Right. Crypto-backed stablecoins tend to be more decentralized, relying on those smart contracts and over-collateralization rules. Fiat-backed ones, by definition, have a central issuer managing the reserves. Much more centralized.
Okay, so decentralized needs some qualification depending on the specific project. Now let's really dig into the risks and blockers. What are the big ones?
Security is a huge one. Our sources point out that as more institutional money flows into crypto and DeFi, any major blowups could have wider implications for financial stability. It's just hard to fully grasp the risks of these new complex products.
And we've seen actual hacks happen, right? Big ones.
Absolutely. Huge amounts lost. One source mentioned over $10 billion lost to crypto hacks just in 2024 so far. And DeFi is a prime target.
Any specific examples?
Sources mentioned a massive $2.5 billion exploit using one of those flash loans we just talked about. The attacker gained control and essentially emptied the coffers. Another was Wintermute losing $162 million. These aren't small changes.
No kidding. And it's not just outside attackers, right? What about exit scams?
Yes, that's another major risk. Projects just vanishing with investors' money. Because of the anonymity some parts of crypto allow, especially related to the darknet, prosecuting these is tough. Billions have been lost this way, too.
So security is paramount. What about regulation? That seems like a constant challenge for crypto.
Definitely. Fintech, and especially DeFi, moves so fast that regulation often struggles to keep up. This creates gray areas that, unfortunately, can be exploited for things like money laundering.
How does that work in DeFi?
Well, many of the risks you see in regular online finance apply here, too, sometimes amplified. Things like hiding identities, moving funds super quickly across borders to jurisdictions with weaker rules, using money mules. DeFi's online, often pseudo-anonymous nature can make these easier.
Are platforms trying to combat this with KYCML, know your customer rules?
Some are, but the decentralized nature makes it challenging. Who is responsible for KYC on a purely peer-to-peer platform? Identifying the ultimate beneficial owner of assets can be really difficult. Plus, using privacy-focused coins can obscure trails further.
And this connects to illicit activities, too.
Yes. Sources mention crypto being used on the dark web for trading stolen data and other illegal goods. While illicit use is a small fraction of total crypto activity, it's still a serious concern. And we're seeing financial fraud increasingly linked with other crimes enabled by this tech.
A complex web of regulatory and criminal challenges. Are there market-specific risks, too, like manipulation?
Sure. DeFi markets have speculative trading, lending, borrowing, so you get risks familiar from traditional markets, like manipulation or conflicts of interest. But DeFi adds its own unique twists.
Such as?
Front-running is a big one, often called MEV, miner extractable value, though it applies beyond just miners now. Basically, someone sees your transaction waiting to be confirmed on the blockchain.
Like a large buy order.
Exactly. And they can jump the queue, maybe by paying a higher transaction fee, place their own order just ahead of yours to profit from the price impact your trade will cause, and then maybe even sell immediately after.
So they're exploiting the public nature of pending transactions.
Precisely. Blockchains like Ethereum are particularly susceptible, and then there are those flash loan attacks, again, not just for governance takeovers, but used in complex ways to manipulate prices on DEXs for profit within that single transaction block.
Wow, okay. So security, regulation, market integrity. What about just getting people to use DeFi? Are there adoption barriers?
Yes. Looking at related tech like mobile payments, sources show that fear of security and fraud is a major barrier in some places. People also just stick with what they know, like cash.
So trust and habit are big factors.
Absolutely. For DeFi, which can seem even more complex and risky than online banking, those hurdles are likely even higher. Building user trust and making it genuinely easy to use are critical for wider adoption.
Okay, we've covered a lot of the challenges. Let's end on a forward-looking note. What does the future hold for DeFi? Where is it heading?
Well, the expectation is continued innovation. Sources suggest a big focus will be on improving user experience, making it simpler and safer, and boosting security.
Making it less scary to use, basically.
Pretty much. Another major area is interoperability, getting different blockchains to talk to each other more easily. That could unlock a lot more liquidity and make the whole ecosystem work better together.
Like building bridges between these separate blockchain islands?
That's a good analogy, yeah. We might also see more hybrid models, things that blend elements of DeFi with traditional centralized finance, CeFi. Try to get the best of both worlds.
Interesting. And regulation will play a big part, presumably.
Hugely significant. How regulators approach DeFi will massively shape its future. Thoughtful regulation could provide stability and trust, while overly hard rules could stifle innovation. It's a balancing act.
What about the core promise, financial inclusion?
That remains a key driving force according to our sources. The potential to offer financial services to people who are currently underserved by the traditional system is a powerful motivator for many in the space.
And how are traditional banks reacting now? Are they still just watching from the sidelines?
Less and less. We see this interesting dynamic where fintechs, including some DeFi players, act almost like R&D labs. Banks then watch, partner, or acquire the successful innovations. There's also growing interest from traditional finance in crypto assets themselves. So we're seeing signs of convergence.
So despite all the risks and hurdles we've discussed, the potential is still there.
Absolutely. The potential for DeFi to reshape finance based on transparency, accessibility, and user empowerment that hasn't gone away. The challenges are real, but so is the drive to innovate.
Okay, so to wrap up our deep dive today, we've journeyed from DeFi's roots in blockchain and Bitcoin, looked at how it works with smart contracts, DXs, and stablecoins, wrestled with the nuances of control and governance, faced the significant risks around security, regulation, and market manipulation, and peered into a future focused on innovation, usability, and maybe, just maybe, greater financial inclusion.
Which leaves us with a final thought for you, the listener. Given this mix of revolutionary potential on one hand and the undeniable risks on the other, how do you think traditional finance and regulators will adapt as DeFi continues to evolve? And thinking about your own financial life, what role might this decentralized world play for you now that you're a bit more informed? Definitely something to ponder.